Hello, everyone, and welcome to today's webinar, Environmental Social Governance, Putting the Theory into Practice After COVID-19. I'm Laura Weiss, CQ Roll Call's ESG reporter and author of the CQ ESG Briefing newsletter, a weekly newsletter delving into the latest news and news analysis on everything related to how companies and investors are addressing ESG issues and facing new pressures from customers, employees, activists, and government. I've got just a few quick housekeeping notes to cover before we get started. You'll see a Q&A box and a chat box on your screen. You can use either of those to submit questions throughout the webinar. Please submit your questions at any time, and we'll attempt to get to as many as possible during our hour together. This session is being recorded, so afterwards you'll be sent a copy of this event. Everyone should be muted upon entry, but if you're not, with the exception of our panelists and for the benefit of our audience, please make sure your microphone is on mute. Today, I'm joined by one of my colleagues and two industry experts who will help guide the conversation and share their insights. They'll also be answering audience questions that you submit. We're coming to you from 4 separate locations today, so please excuse any variations in sound quality or small pauses. I'll give you a short introduction for each panelist, and they can tell you more about what they do in the course of our discussion. My colleague, Katie Bays, is Managing Director for FiscalNote Markets. FiscalNote Markets gives clients a competitive edge by combining best-on-the-street analysis with robust AI-powered technology to evaluate the impacts of policy and regulation on sectors and companies. Katie offers best-in-class insight into regulatory risks faced by electric utilities, midstream and LNG companies, and upstream oil and gas producers. Her experience and deep relationships with state and federal policy makers gives her a unique edge in offering predictive insight and analysis of political, regulatory, and legal catalysts. Holly Emerson is Senior Analyst at Trane Technologies. Holly focuses on defining and implementing metrics for innovation in the green space. Her efforts help guide product development and product stewardship, and she also collaborates with the Global Procurement and Integrated Supply Chain Group to integrate sustainability into supplier quality and compliance programs. Holly's external reporting expertise and knowledge has helped the company improve on the Dow Jones Sustainability Index and Carbon Disclosure Project. Finally, Nick Anstead is a Senior Director at Albright Stonebridge Group, where he advises organizations on corporate sustainability, development finance, cross-sector partnerships, and critical environmental, social, and governance issues in global markets. Nick brings over a decade of experience working across sectors, industries, and functions to help organizations and leaders shape critical sustainability initiatives that draw on the core capabilities of the business, earn buy-in from senior leaders inside and outside of the organization, and position the company to deliver significant value to stakeholders. Now we're going to get into some questions. ESG is still a relatively new trend, but it's gained significant legitimacy as an investment strategy and area for corporate risk consideration, particularly during the COVID-19 pandemic. To start, I wanted to ask Katie, can you tell us a bit about the trends you're seeing when it comes to ESG investing and performance?
Hi, Laura. Yeah, thank you. It's so fun to be here with you all, and I'm so delighted to be here with Nick and Holly as well. I think this is a wonderful place to start, and especially because some of our audience may not be as familiar with the institutional investor universe, I thought it might be nice to kind of start off with, what is going on in the market today when we see this growth in ESG investing. We've heard a lot about outperformance of ESG and sustainable funds in 2019 and in the first half of 2020. But what does all of that really mean, and what does that mean for companies especially? So when we talk about funds that are outperforming, ESG and sustainability focused funds have indeed outperformed their more conventional peers in the last 18 months or so. What that means is not that all funds have outperformed, but that generally speaking, an ESG or sustainability focused fund has been more likely to outperform or to be at the top quartile of performance than fundamentally focused funds. So there could be a lot of reasons why that is the case, and I think that's where the investment community is now trying to unravel the significance of ESG in its strategies overall, but a couple of criteria that are kind of common to an ESG fund may speak a little bit to why that outperformance has happened. So for instance, ESG funds, especially in the US, tend to be underweight in energy, and energy as a sector, my beloved little corner of the universe, has actually kind of drifted into it's very decisively in a recession now, as is much of the rest of the economy. But even at the beginning of 2020, energy was entering into a technical recession and a technical contraction. So we had a sector that was outperforming, which was the tech sector. We had another sector underperforming, which is energy sector. And those trends, those larger trends, actually probably benefited ESG and sustainability focused funds, which themselves tend to emphasize tech more heavily and underemphasize energy. So there's a lot of things going on around when you hear that headline, ESG funds are outperforming. There are a lot of reasons why that's happening, and those reasons are really important when we start thinking about where is the future of ESG going for the institutional investor universe. You can also look at one of the other big important criteria for investors, which is inflows. How many new people are showing up, giving money to my fund and believing in and buying into my investment thesis. And that's another area where ESG has really shined, especially in the first quarter of this year. We saw about $36 billion of new money inflows into ESG funds. The big outperformer region was actually the EU, but in both the UK and the US, we saw outperformance in terms of new money going into ESG. So why does all of this really matter? Basically, it's important because it speaks to how much money is available to invest around ESG or sustainable companies and corporate strategies, and to really underwrite this social trend that we're experiencing, especially in the United States right now. But that ESG analysis is not, it shouldn't also be thought of only as the province of those ESG specific funds and sustainability specific funds. And this is where I'll actually speak as a person who advises institutional investors broadly, so not just focused on one strategy like ESG. Our clients are hearing from their investors across the board. What is your strategy around ESG? What is your evaluative criteria when you're looking at an investment? How do you decide whether or not an investment is going to generate the kind of return? And how do you think about ESG in that context? And so that's something which actually all investors that we work with right now are dealing with in some way, shape, or form, even some that you might not expect, like the hedge funds of the world, the more secretive and private institutions are also getting these questions from their clients, which I think is a fascinating and really interesting statement about where we are as a society right now.
Thank you so much, Katie. It's really interesting thinking about the investor trends going on as a frame for our discussion, and thanks for walking us through that. Holly, I was hoping you could also touch a bit on how some of the confusion around the number of questionnaires, reporting frameworks, and demands when it comes to ESG for companies, and if you could give us a quick sense of whether there is some growing consensus on what information companies are expected to focus on.
All right. Well, good morning, good afternoon, everybody. This is Holly Emerson, and it is very nice indeed to be here. Thank you for asking me to join you on this call. We're certainly seeing more clarity, I think, around what investors are looking for and what disclosures are material. I think generally accepted industry material factors have evolved, and I think there's greater clarity around that thanks to the work of SASB and TCFD and also GRI. And there's also been a lot of consolidation of these ratings and rankings. We've seen, I think the most recent one is that S&P bought Refrigerant and formerly DJSI questionnaire, then Rebecca Sam CSA questionnaire is now the S&P questionnaire. And I think with this consolidation comes a little bit more clarity. We engage with ISS and Sustainalytics to help them understand, what we're disclosing and what our material issues are. And that engagement has, I think that those firms have become much more willing to engage with companies in recent years. And I think even they have, there's more clarity. I wouldn't say consistency across the board, but because they each bring a different value proposition. But there's certainly more clarity around what metrics they're looking for, what information they're looking for, management factors, and so forth. I think that I think labor metrics have been traditionally kind of not really well correlated among the rating agencies, and I think that there will be more clarity given the issues with COVID. I think that there will be more clarity around labor metrics in the coming years. I expect to see that, and in terms of what, and it may be on an industry-specific materiality basis, which is the way environmental metrics are often viewed. That materiality is really key, and today we see that more with the environmental factors than we do necessarily with the social factors, I think. I think that this idea of valuing impact and externalities is also maturing. The WEF, the World Economic Forum, released in January, I'm sure you all know, guidance around metrics that they believe can lead to consistent reporting of value creation. And included in the recommendations are the measurement of societal impacts, so impact valuations from climate-related factors. And in fact, S&P's CSA questionnaire includes impact valuation in one of their sections. So I think that's another area that's growing, and there's also more clarity around that. I think there's existing frameworks, and there will be that area will mature in the coming years. I think that companies that can really articulate why sustainability is important to their business, what's most material, and I think what will result from that are better disclosures and more impactful conversations with investors and with customers. We're seeing much more focused questions from investors, and I think this really stemmed from our climate commitment, which was around reducing our product's impact. As an HVAC company, we a pure play climate company, we have our products have significant impact, and we measure that and we disclose that, but we also have commitments to reduce that, and so that is, that attracts attention. I think it also attracts questions, invites questions, and we're able to really articulate our story and why this opportunity presents itself to us and how we're addressing it. So yes, I think in conclusion, there is a lot more clarity, and I think that consolidation is kind of driving that clarity among these questionnaires and disclosures.
Great, thank you so much, Holly. And to shift to sort of one of the trends you mentioned, how COVID-19 has changed ESG and shifted ESG, at least for the moment. The coronavirus pandemic has really elevated social risk and workforce management. And more recently, there's also a lot of focus on workforce diversity with pressure on companies over systemic racism and inequities within their organizations. So Nick, I was hoping you could start us off talking about whether you expect this year to produce lasting change in ESG.
Yeah, happy to answer that. And, I'll add my thanks to the FiscalNote team for having me and for everyone joining today. Just taking a very quick step back, and, Holly and Katie both mentioned this, but really materiality is fundamental to the concept of ESG. ESG is really just another means of talking about sustainable business, about business for social good, about shareholderism versus stakeholderism. But it's a concept that's originated within the financial industry, and it's a concept that drives really hard at trying to understand which of these environmental, social, and governance factors are most material to the financial results of a business. Where are there greatest correlations between a particular factor and positive financial outcomes. So it's very much instrumental in that sense. It's very much tied to the shareholder outcomes. And mention that in the context of talking about social sustainability and the S and ESG, because as mentioned, this is a concept that has almost become cliche over the last couple of months in newspaper headlines talking about the rise of S. And a lot of people are trying to understand and anticipate where that's going to go post-COVID. Now, social sustainability was traditionally neglected to a certain extent in ESG frameworks, primarily because there weren't the frequency of correlations discovered between social sustainability factors and financial outcomes. They're more challenging to define. They're more challenging to measure and more challenging to track, and for that reason, it was sort of under-reviewed and understudied. As sort of a concrete example, just consider the difference between trying to understand and track environmental outcomes. Water usage at a facility, it's pretty simple to understand that if you're in a at-risk or a water-scarce region and yet you have a water-intensive manufacturing process, if you can calculate your reduction in water usage by a certain percent and in scenario planning exercises understand how much stress would be placed on your business in certain environmental scenarios, you can pretty quickly calculate the value at risk to your business and the cost savings potentially by creating more water efficient manufacturing processes. If you compare that, for example, to one of SASB, the Sustainability Accounting Standing Board's or Standards Board's social sustainability criteria in either community relations or labor relations, and start to think, how do you define a company's relationship with labor or levels of employee engagement or levels of community relations? What exactly are you tracking in that sense? How do you know what causality is? These are really difficult questions for companies to answer, and because they've been such a challenge, the S has traditionally been neglected. But now we find ourselves in an environment where a lot of companies are seeing, material impacts on their financial results as a result of labor relations issues, employee health and safety, challenges in the supply chain, all come to light as a result of COVID. And so it is raising the S on par with the E and G in terms of how we think about these issues and how much airtime they get. But the fundamental challenges still remain, and that's the fact that it remains very difficult to define and measure social sustainability criteria, and those challenges will persist. And for that reason, I think you're already seeing some of the big data firms that track some of these metrics, materiality, dynamic materiality of social sustainability factors has already started to wane, these months into the crisis. You're seeing a lot of big corporate action continue to be driven towards environmental factors. So again, to summarize, I think the social sustainability aspects are very much going to be on people's minds. It's going to drive a lot of research and consideration of causality. As Holly mentioned, it's going to drive a lot of additional thinking on how we account for social sustainability, what disclosures we require in those areas. But I think we're still some years off from chief financial officers, investor relations teams, other people in the operating business units being able to consider social sustainability criteria on par with more easy to measure environmental or even governance criteria.
Thank you so much, Nick. And to turn to another trend related to the pandemic, climate change has really been a driving force behind a lot of ESG. And Holly, I was wondering if you could start us off talking about how the pandemic has influenced climate risk management and public perception.
Well, I think it's changed the level of public awareness. So it's so in your face, or it has been in your face, especially early on in this pandemic, when parts of the world see clear skies for the first time, and in some cases like their lifetime, and I think that the challenge will be to ensure that this becomes, to try and preserve that, and that this becomes the new normal. I mean, the reality is that it barely put a dent in CO2 emissions or greenhouse gas emissions, and so we have a long ways to go. And that was also eye-opening, and maybe not for the general public, but certainly for companies, for NGOs, for investors, that this in order to meet the goals of the Paris Climate Agreement and the revised guidance of the IPCC, is really, we have to double down and be serious about impact. And so I think that's changed the conversation a little bit. It's put greater emphasis on, solid, aggressive greenhouse gas reduction targets. We had set pretty aggressive targets before the pandemic, and since then the company is actually split. We haven't let our foot off the gas. We're investing in renewables and plowing ahead with refrigerant transition, and addressing basically all areas of impact of the company. So, and I think that we're among friends, many of our peers, our competitors, and other leading companies are doing the same, basically doubling down. And you've seen it. You've seen all of the commitments that have been announced in the news. So, so I think it's just general public awareness. But I think, in terms of risk management, I think companies have really started, even pre-pandemic, to integrate climate-related issues into their enterprise risk management system, or their enterprise risk management process. We have a fairly robust process that already incorporates climate-related factors into our corporate risk factors, and that what that does is it gives visibility of those issues that may not rise to the level of financial materiality to the CFO. So, the CFO is chair of the Enterprise Risk Management Committee, and we talk about these issues in our quarterly meetings. And when I say they don't rise to the level of financial materiality, we do have some that do, and we have a comprehensive disclosure in our filings around that, specifically around refrigerant management. So to us, it almost feels like opportunity management rather than risk management. And I think for other leading companies, it does as well. I think that looking at different ways of just working, and how that's going to impact emissions from commuting or emissions from travel, all of these things that companies have historically kind of estimated and disclosed, or tracked and disclosed. Virtual meetings may become the norm. And I think that companies will scrutinize their measurement of those impacts and start to disclose those in a more comprehensive way. And there's social implications there too, because you're giving employees potentially a better quality of life by giving them the flexibility. So I think the challenge, of course, will be to avoid the rebound effect, or maybe negative consequences, such as, we're hearing about people not taking public transportation because they're just, no blame, because they're, just cautious in this time, and prefer to use a car or an Uber or their personal automobile or whatever. And of course, that's going to increase emissions from commuting. So, in terms, so I said, it feels like opportunity management. I think that leading companies that have identified what is most material to the organization and how this dialogue and story around sustainability is really driving their corporate strategy, their business strategy globally, will are addressing these climate issues and climate risks in a very positive manner. That could be increasing energy efficiency of products, providing access to cooling, access to fresh water, access to clean air, developing technologies that can enhance that, and addressing things like social inequities around those issues. I think of things that are obviously related to what we do, but it's an opportunity for us to innovate around these issues. One example would be the quality of indoor air and how important that is going to be in the future, and that's a real opportunity to develop technologies that address indoor air quality, clean indoor air, while also minimizing the impact on energy consumption, and while transitioning out of high GWP refrigerants. So there's a lot of opportunity there globally, I think, really in the area of access to cooling. I think those are my main points around climate risk. That's the way we're addressing it, and that's the way I think leading companies are looking at it.
Mm-hmm.
Yeah, and Laura, if you don't mind, this is Katie Bates. I wanted to see if I could hop in and
Please.
kind of piggyback off of some things that both Holly and Nick were saying, because, I think exactly where Holly is going is this conversation around the change in what constitutes a material, what constitutes that threshold of materiality, and the kinds of activities that companies maybe 10 or 15 years ago might not have considered, but which would be part of a core business model now. And for my clients, for the institutional investor community, at the end of the day, all of this gets back to a question of where do I put money to work? Where, as Nick was saying, where is the best place to deploy capital and produce the best risk-adjusted return? And ESG really has a powerful ability to speak to and guide my analysis of expected returns, but we're not quite there. And climate is, I think, probably the most well-developed part of the ESG analysis in terms of, it's the area where I think for my clients, they're best apprised of how does the public perceive this risk? What exactly is the risk? What are companies doing to exacerbate or reduce risk? And especially in energy, that is such a unique area because all of these energy companies, upstream oil and gas companies, midstream companies, utility companies, all have significant emissions profiles that are difficult to, it's hard if your job is to produce oil and gas, it's pretty hard to innovate your way out of producing oil and gas. So you have certain sectors that get kind of stuck in this bit of a, dated or kind of falling out of favor political environment, but that has not yet, and this is one of the things I think is really interesting to see as we have this conversation, is at some point the metrics in ESG become well developed enough that they can actually be used to gauge risk in investment and make and justify a cheaper cost of capital for ESG friendly activities. So what I mean by that is just, this idea of a sustainable bond or green bond that is supposed to be deployed to support activities that are low carbon, like an offshore wind project or a renewable project or a transmission line carrying renewable energy from one part of the country to another. Those kinds of activities should be consistent with this climate reduction strategy that we are embarking on as a society. But at the same time, we are not in an environment today where the cost of capital for those projects is necessarily lower than it would be for a project that didn't have those green characteristics. And I think that's one of the biggest challenges for the investment community and for companies as we all work together to try to articulate what the value of our ESG strategies really is can you demonstrate that projects that have, and I'm focusing on infrastructure because infrastructure is expensive, it's typically very controversial, and has a lot of, it can be potentially very good for climate progress, or it can be kind of reductive. So infrastructure is kind of an interesting world where green bonds or sustainable finance has yet to really break in, especially in the US, and provide a path to lower cost of capital to really spur the development of lots of new infrastructure and lots of new projects that fit that low emitting sort of profile. I think that's one of the big challenges for the financial industry. One of the big challenges for defining what ESG is really tying it back and durably tying it back to returns. And then seeing for our public, you know, where much of the controversy around big projects tends to originate, for the public, how do you properly communicate the social value of a big investment at that sort of global scale? When we make an investment, we are replacing high emitting generation with low emitting generation. How do you get that message across to the public so that folks generally feel like, you know, these are projects that are worth supporting, and therefore they have better political outcomes, regulatory outcomes, and a better return profile than projects that face widespread public opposition? I think that's a lot of the themes that Nick and Holly were talking about are ones that we see our clients wrestling with all the time.
Thanks, Katie. I'm wondering, when you talk about some of these trends, there has been some pressure and talk, and particularly in Europe, about sort of green recovery efforts from coronavirus. Do you think that that could have any impact on sort of the environment for some of these trends?
And that, to me, sorry, go ahead. Nick, you're probably in the best position to answer that.
No, I mean, happy to add some views, but you know, I mean, reiterating what you've mentioned, especially with the infrastructure asset class, I think a lot of the green recovery efforts, both in the EU as well as some of the ones that are being spurred in emerging markets, either by multilateral development banks, development finance institutions, or the governments themselves, will focus on either green energy infrastructure, will focus on hard transportation, water and waste infrastructure, and other areas. You know, and it's because it's the biggest asset class. It's job intensive, so you can get people to work as well as greening the economy. Tied deeply to the resilience agenda, which brings us back to sort of financial risk as well. So infrastructure is, you know, an important asset class, and the bailout recovery programs will put a lot of focus on greening infrastructure. There will be, I mean, for the ESG debate, it's important to understand that'll create a lot of new investments, private investment funneled towards those areas, which will eventually create, you know, other sort of fixed income and equity categories as well. Also important that there's going to be a lot of pressure on developed and developing markets in pursuing these big infrastructure spending plans to ensure not just that they're supporting green projects, but that the projects themselves are embedded with ESG criteria. So if you're building a large wind farm in Kenya, ensuring that it doesn't disrupt biodiversity to a terrible extent, that you're supporting strong labor relations on site, that the supply chain, that you're looking at social environmental governance concerns within the supply chain. So there'll be a lot of pressure there as well. And a lot of the MDBs and DFIs have recently done a lot of work integrating ESG into their investment considerations. And so this will really put a lot of that to the test, because people will be pressured to get capital out the door quickly. But taking into consideration some of these ESG factors in due diligence is challenging. It's even more challenging when due diligence is happening virtually in this current environment. And so it'll really put some of those frameworks to the test. So I guess there's two things there. One, it's going to create a significant amount of green investment, no doubt, and that will sort of further advance this sort of broader asset class. But two, you know, green infrastructure itself has ESG considerations and concerns built into it, and being green in and of itself is not enough to satisfy or to check the boxes on ESG. There's a lot of other things that need to be taken into consideration, and those models will be put to the test here.
Great, thanks, Nick. So I actually wanted to ask you another question when it comes to stakeholder consideration. and what gets priority in a time of crisis like this. In particular, there's been skepticism from the public and especially ESG-focused investors on whether companies are equally committed to stakeholders or even can be, looking at employees, supply chains, communities, customers, shareholders. So as we were saying, governments and economies look to rebuild, what is a realistic balance of stakeholder considerations and some of the potential pitfalls there?
Yeah, certainly. And as listeners are probably understanding, and by how much Katie and Holly and I are building off of each other, all of these elements are so very integrated that you have to think of ESG in its entirety. You have to think of all stakeholder groups in their entirety, because there's a lot of knock-on effects throughout the system. Focusing on social sustainability in particular, again, following on from that conversation, through the recovery, there are going to be decisions that companies will make that appear to be positive in terms of social sustainability. One in particular is around employee health and safety. There may be a bias in terms of improving employee health and safety, or even building a more resilient supply chain to advance automation initiatives or AI-based initiatives at businesses that had maybe been put on the back burner for fear of labor disruption, or just being unwilling to invest in those types of projects. There's significant rationale for doing that now, and in some cases, in advancing sort of employee health and safety and other measures, it seems very positive. But there will be the knock-on effects of increased labor market disruption. If you're rationalizing supply chains in emerging markets, oftentimes those supply chains are staffed by the most marginalized, vulnerable, at-risk groups, women and visible minorities and other groups. And so you're putting individuals like that at a more compromised position. So there's a lot of decisions that businesses will make coming through the crisis that will seem positive on the surface, but there are sort of knock-on effects to other stakeholder groups for whom there'll be a greater trade-off, and businesses need to account for these things. Once again, a lot of the social sustainability issues continue to be very difficult to measure, monitor, define, to assess materiality for. And I think this is where folks within institutions that continue to be responsible for corporate affairs, stakeholder relations, government relations, other categories like that, will have to continue to play an outsized role. We know that these issues are important. We know that there's significant value at risk due to inequality, due to racial, gender, and economic diversity issues, with social unrest, with geopolitical unrest. We know that there's value at risk. We see that happening anecdotally. And so businesses still need to address these issues, even if there's not a clear financial link to them all of the time. And for that, it really takes a lot of the sort of art and qualitative work of the corporate affairs teams and stakeholder relations teams to engage as much with stakeholders, to understand these emerging ESG risks to come from some big corporate decisions now through the crisis, to find ways to try to address those or mitigate their impact. And sometimes that's traditional corporate philanthropy or CSR. Sometimes there's shared value solutions to be found to drive some of those projects forward. And sometimes it's as simple as just straight stakeholder engagement and trying to be aware of some of the stakeholder challenges. So, again, there will be any decisions that companies are making with respect to ESG considerations, or even major business decisions to build resiliency to the next crisis. There will be trade-offs with stakeholder groups. Inevitably, there's always going to be one group prioritized over another. And we really have to be aware of who those groups are, because they really present what tomorrow's ESG risks will be.
Thanks, Nick. I think that's really interesting in sort of the ever-evolving nature of ESG, of sort of now that it is here as something to consider. It's not really, you're not going to check the boxes and sort of move on. So I just wanted to quickly at this point remind everyone to submit questions if you'd like, and then to just ask one last question of you all before we move on to audience questions, which is if you could quickly talk about, with November's upcoming presidential election, how that's influencing your perception of public policy and regulatory risk. Katie, if you want to start us off there.
Yeah, thank you, Laura. This is a fun question. So our clients, our investor clients, want to pick winners. And I don't think it has ever been harder to pick a winner in the corporate world, or even looking at the folks running for reelection, than it is right now. And that creates this incredibly complex and difficult investing landscape. And so, and of course, we have as a convenient backdrop a global pandemic. So there's just this massive amount of difficult to quantify risk. And that has, and I think will continue to put a hold on significant new investment in any kind of potentially like a gray area space where a company may not have, like Nick was just saying, may not have a great relationship with some stakeholders, or may have, you know, a traditionally acrimonious relationship where the company is making investments that are dependent heavily on policy continuity. All of these things are really difficult to get comfortable with when you're putting significant amounts of money to work. And that's influencing the market today. But when we think about, you know, moving forward, and if we envision a world maybe where we've got a President Biden, I think there are a number of really significant opportunities for new investment to kind of emerge around the ESG theme. And a lot of that is sort of what we've been talking about through this call. It's the idea of creating greater consistency and clarity amongst the ESG metrics. It's the idea of clarifying that materiality threshold and creating some good structure around the connection between good ESG strategy and policy and positive economic and financial returns for companies, and getting into the ability to really use ESG as a way of underwriting and investment, and looking at, you know, again, kind of getting to the green bond, sustainable bond concept as a way of saying, look, this is a low risk investment, therefore it should not be as expensive. I should, as an investor, be satisfied with lower returns. And we all, you know, as a society, benefit from seeing lots of capital go to work in the places that, from a public policy perspective, we want to see that go to work. And one of the ways I think that, you know, this election may help harmonize those strategies is that we have a big delta between where the public is today on issues of ESG and where our public policy is today. And so seeing some more convergence at the public policy level and getting a bit closer to where maybe mainstream America is, especially corporate America, around what good looks like, I think could really help the investment community also get comfortable with the role that ESG has to play in making investment decisions.
Thanks, Katie. And you know,
Laura, I mean, maybe while you're thinking that, I'll just jump in really quickly and say, you know, regulatory risk is one thing, and I think that there's obviously in the Biden administration there would be certain regulatory risks posed to high emitting businesses and those in transition industries, to the financial sector, to others. With respect to the ESG agenda, though, I mean, I will sort of say, you maybe get hints of a Canadian accent here, and so it's maybe easy for me to say because I can't vote. But with respect to the ESG agenda, I don't think the outcome of the election matters one bit. I think this agenda is being set globally absent U.S. leadership. I think it's being led in a large part by global financial institutions, a lot of them American financial institutions. I think the EU is taking up the regulatory mantle on this and pushing hard. Asia Pacific is starting to consider these issues in a bigger way, and a lot of their big public pensions are leading the way on those types of things. I think with respect to ESG, I mean, some folks may have seen a Department of Labor comment proposal put out recently to ensure that any employee pension funds don't prioritize ESG investments over others. That's been met with a significant amount of opposition from pretty hard capitalist institutional investors who see the financial benefits and financial outperformance of ESG criteria. I think you also see in Europe, you know, Christine Lagarde and the ECB and others taking the exact opposite approach, the Principles for Responsible Investment, which has 2,500 signatories among asset managers, that is sort of says the exact opposite, which is asset managers must consider ESG criteria because they are deeply material to financial performance. So on the ESG piece, there's certainly regulatory considerations which will increase ESG risk for companies. But as far as the broader ESG agenda, I think regardless of how this election turns out, that agenda is going to continue to plow forward.
Yeah, this is Holly Emerson. I was going to challenge that comment, Nick, but but then you kind of saved yourself at the end. I would say that this administration has really put up some serious roadblocks for investment of renewable energy. It's really affected how companies can procure clean energy or renewable energy to meet their goals, and it's also, well, there's job security because we do, like many companies, we advocate for policies that provide shared value, right? So that for example, refrigerant transition, it's good for, it reduces climate impacts, but it also enables us to position ourselves in the market and avoid stranded assets, right, which is a huge risk. So I think that, but in terms of a broader ESG agenda, it's definitely true because we signed on to We Are Still In, and thousands of entities did, and so there was clearly the will of the public to to buck the administration and say we're aligned with Paris, the goals from the Paris Agreement, and we intend to keep pursuing them. Just one final comment about cost of capital and sustainability bonds. I would agree. I mean, we've been kind of monitoring this and developments, with the emergence of sustainability bonds, which are tied to ESG factors, not necessarily linked to specific projects. And the cost of capital it's not there yet, I think. I mean, you're just not saving, you're not saving a lot of money, I think, basically. But we're definitely, that's in the hopper of consideration, and I imagine that we'll issue one soon in the near term, because they are, it does, bring it does kind of, it enables us to really tell our story too in a different venue. So those are my comments to the prior speaker's comments.
And tying in the coronavirus pandemic, I know that one of the things we've seen is Democrats angling to ban stock buybacks, limit executive pay, or require ESG disclosures, especially more progressive Democrats, tied to some of this relief. And so I'm wondering if you think that's a sign for the future, or if it shows where some of the policy priorities may be moving on the left.
Yeah, I can put my political speculation hat on. This is Katie. I do think you're right, Laura, like that the job, I think, of the progressive left in the US in particular is to drag the conversation as far into the future as you can imagine and envision. And I think some of the conversations that are happening right now in the Democratic Party and looking at Joe Biden's energy and climate platform, those are not conversations, this discussion around getting to net zero in the power sector by 2035 and in the economy by 2050, those are not conversations that we were really having 10 years ago. And it is amazing to see how quickly really technology, corporate innovation, but public attitudes have shifted so that you can accommodate a future that we didn't envision. And I think that's where, from our perspective, we see a lot of the political advocacy and messaging amongst the progressive left focused right now is what comes next. So what kinds of technologies and what kinds of goals and what kinds of penalties for bad actors are we pursuing that are not necessarily going to happen, but are designed to serve as, what an investor would think of as sort of your downside case or your worst case scenario. When I make that downside case even more egregious, I can eliminate some of the less desirable activity, because something that might be investable and bankable becomes uninvestable when, in a worst case scenario, it's a big money losing enterprise. So I hope that makes a little sense. I think that's from where we sit. That's where we see the real impact of some of the conversations that go beyond what public policy is probably likely to do in the next couple of years, but get into a more of a vision selling exercise for the more pro-environmental community.
Thanks, Katie. And just a reminder for anyone that wants to keep submitting questions. The next one we're going to get to is, and whoever can take this, what questions around ESG aren't being asked that you think really need to be right now?
This is Holly. I can just quickly chime in about, just related to what I mentioned earlier is, I think more disclosure and description around policy advocacy, because right now it seems like it's a yes or no. And if you answer yes, it's a negative, because the assumption is that you're advocating for, for benefit of the company only, or for benefit of the shareholders only, I guess you could say. But in reality, there is shared value there from progressive policy advocacy on some of these issues. And so I think the ability to provide clarity around that and be judged on the alignment, which I think the Climate Action 100 is doing that some, but I've seen some questionnaires where it's just a yes or no. And so it's not a very meaningful answer.
Thanks, Holly. The next audience question we have is, can you add more clarity on what technologies you think of when speaking about refrigerant capabilities transitions?
Was that around refrigerant transition? Is that what the?
Yes.
Okay, so this is Holly. Technologies. Well, so Kigali is the amendment to the Montreal Protocol, and has a scheduled phase down of HFC refrigerants, and so by I think it's 2050. I'm not a refrigerant expert. The entire world will be phased out of high GWP refrigerants, which are HFCs, transition to either natural refrigerants or HFOs. And so our challenge is to develop technologies that either use natural refrigerants, low GWP refrigerants, HFOs, or olefin-based refrigerants, or no refrigerant, and think differently about cooling. And we do have some technologies that use like reclaimed CO2, which could be considered a natural refrigerant, and it's reclaimed. So the challenge, though, is to transition out of those high GWP refrigerants while maintaining energy efficiency or increasing energy efficiency of our products, because really the biggest impact of our products is through the energy that they consume, not the refrigerants that are emitted gradually over time. And then the other innovation will be, I think, around destruction of refrigerants, high GWP refrigerants, and reclaiming those. I think there are some estimates. Well, a large number of refrigerants are vented, sadly, from residential or commercial units by the service industry, and because there's a lack of incentive to reclaim the refrigerant. It's better, it's better for their profits to sell more refrigerant and just vent the old stuff. So changing the paradigm around that and providing incentives for reclamation and then use for reclaimed refrigerants, I think will be another innovation. So it's not just around the products themselves, but it's also around the services. And to think differently about cooling. So in our case, I mean, refrigerants are used in many places, but we, we're a climate company, so we're focused on cooling and maintaining indoor temperature and air quality.
Thanks, Holly. I think we're going to have time for one more audience question, which is, in what areas should we be looking to European ESG programs to inform what will evolve in the US market? So would you want to start this off?
Yeah, I mean, I can really quickly say, I'll note I'm not a particular expert on some of the European policy landscape that is coming, but as sort of both Katie and Holly have mentioned, there's a lot of work happening around harmonization of ESG disclosure, and Europe's really leading the way on that. They've been attempting through the EU green taxonomy to better classify what is and is not green in an investable sense. And we'll continue to look for how accounting practices and disclosure practices will evolve. So watch for that. It continues to be a really big challenge. It's why you get such heterogeneous outcomes from rating agencies on ESG matters, why sort of investment strategies in ESG can vary so greatly. It's because there is not a clear and consistent set of disclosures, definitions, metrics in this space. And that's really where they're focusing their energy right now, is on trying to bring some clarity to that.
Thanks, Nick. And I think we actually are going to fit in one more question, which is, if a company was starting an ESG program, would you recommend using the WEF metrics report?
This is Holly. It's a good place to start. I think start with GRI. GRI and the S&P CSA, and I can't remember what CSA stands for, but it's the old it was formerly DJSI, the Dow Jones Sustainability Index. Those are really good frameworks. I mean, we basically, we grew our sustainability program or strategy, if you will, by repeatedly answering the DJSI questionnaire. And it really gave us a good framework about how to think about these issues and what kind of policies we needed to implement, where we needed to make progress. So I mean, the World Economic Forum's guidelines are just that, they're guidelines. I think that the more generally accepted ones today are GRI's definition of materiality and factors to disclose, and filling out the DJSI questionnaire, the S&P questionnaire. Mm-hmm.
Thanks, Holly. This has been a great conversation. Unfortunately, we're out of time. Katie, Holly, and Nick, thank you so much for taking the time to participate today. It's been a great conversation and very insightful. And to you in the audience, thanks for joining us and taking an hour out of your day to be here. Look for a follow-up email shortly with a link to today's recording. Thanks again, and have a great rest of your day, everyone.